Thank you, everyone, for joining us this afternoon. My name is Jason Ritzenthaler, and I'm Co-Chief Investment Officer at Members Trust Company. I welcome you today, and thank you for your time as we talk about charitable donation accounts and how a charitable donation account program could actually help you increase your funding for the National Credit Union of Firefighters, National Council of Firefighters Credit Union, and improve the operating results and the return on assets for your credit union. It truly can be a win-win, and in working with Grant, we're really encouraged that this could be a way that you could increase your support and be responsible to your members. Just a couple quick housekeeping items. We will do question and answer at the end of today's presentation. In order to participate, please enter your audio pin so that I can unmute you. We will have everyone muted throughout the presentation. That limits the background noise, but we'd like to have a question and answer at the end. Also, the handouts today are available in the webinar software. We'll also provide those afterwards to everyone. So we have quite a bit to cover today, so let's go ahead and get started. As I mentioned, we partnered with Grant and wanted to kind of provide more information to credit unions and to the supporting organizations on charitable donation accounts. There's certainly a lot of interest in CDA investments and the alternative way to fund charitable contributions, and we wanted to provide some information and also to address some maybe common misconceptions and things regarding charitable donation accounts. All credit unions, all credit union organizations want to increase their support to organizations like the National Council of Firefighters Credit Unions. Obviously, they do some amazing work and important work servicing firefighters, first responders, and their families. And as credit union executives, we want to be responsible to our members also. And that's really where a charitable donation account comes in. It truly can be a win-win for the organizations we support and the credit unions as a whole. Just a little background on Members Trust Company. We're QSO. We're owned by over 40 credit unions across the country. Our mission and why credit unions created us was to provide wealth management trust services to credit unions and their members with the credit union values and ideals. Our intention is to compete with Northern Trust, the Charles Schwabs, the Vanguards of the world, but do it, as I mentioned, with credit unions and values and ideals. And that's how Members Trust Company was born back in 1987. Today, we manage about $3.3 billion in assets for credit unions and their members. About $1 billion of that is capital investments for credit unions through charitable donation accounts, which we're talking about today, and also employee benefit funding. Both programs allow you to expand your investment powers to fund either charitable donations or employee benefit costs, like healthcare premiums. Both programs are win-win, allow you to increase your charitable giving or increase the pool of employee benefits while improving the financial results of the credit unions as a whole. So really encourage you to look at both programs. Back in 2010 and 11, Members Trust Company worked with NCUA and CUNA to develop what now is the charitable donation account rule. Happy to report that since then, credit unions have invested over $720 million in charitable donation accounts in 40 of 50 states. What's interesting is initially the largest credit unions in the country were the early adopters. Since then, we've seen the largest growth in smaller and mid-sized credit unions as they see the benefits that the larger organizations have experienced over the last few years, and want to have the same impact on their local communities and organizations they support, like the National Council of Firefighter Credit Unions. Our credit union partners have earned over $53 million on their CDA investments. And that's funded roughly $27 million in increased contributions to charitable organizations. That is 4 times more that credit unions are able to give. And let's talk about how that happens. We all know a credit union, when they're looking at their capital or excess liquidity, are limited in what their investment options are available to them. They can invest in treasuries, agencies, mortgage-backed securities. Unfortunately, interest rates are extremely low. One reason why we started the charitable donation account program is we listened to our credit union owners, and they were looking at alternative ways to invest their excess liquidity and their capital. That's where the charitable donation account was born. And what we found is credit unions, since we've worked with them, they've earned $53 million on their investment. That's $38 million more than they would have through their standard capital investments that today are earning 1% if credit unions are lucky. That number is quickly declining. The average yield on credit union investments in today's interest rate environment is about 1%. And that number, as I mentioned, is going down as interest rates continue to stay low. These are alternative investment strategies that over the long term, credit unions can see 4, 5, 6% returns in responsible investments. We're not telling credit unions to take excess risk. These are responsible investments, similar to investments you would make within your pensions or your employees would make within their 401k plans. Credit unions have the ability to make these same types of investments through a charitable donation account program. And this is really where it becomes a win-win for the credit union and the organizations you support. So just real high level, how a charitable donation account works is NCUA and state chartered credit unions have the ability to do this as well. Most states have parity provisions and approvals, and we haven't had a state yet that has said, no, we're not going to give our state chartered credit unions the same ability as federal credit unions. So if you're a state chartered organization, let's talk. Most states have already approved it. As I mentioned, 40 out of 50 states have charitable donation account investments or credit unions in those states. So basically, NCUA says you can utilize these expanded investment powers as long as the credit union donates a minimum of 51% of the total return on the investment over a 5-year window. The total return is the dividends and the interest the portfolio generates, but also the price accumulation. So over time, asset prices tend to go up, and that's included in the total return. What we find is most of the organizations that we work with, credit unions, they're funding the National Council of Firefighter Credit Union on an annual basis. And so we're actually doing these calculations annually, but you have the ability and the flexibility to do it on a 5-year period. So let's just go through a real simple example. A credit union makes $1 million investment. Over the course of that year, the investment grows by $50,000. So that's a $50,000 return. The credit union recognizes $50,000 of income. Now, the CDA rule says the credit union has to donate at least 51%. So in round numbers, let's say that's $25,000. So the credit union donates $25,000. So they've earned $50,000, which is a 5% return. They've improved their return on assets, and they're required to donate $25,000 of that. It is a win-win. And this is where we've seen charitable contributions increase and funding for organizations like the National Council of Firefighter Credit Union in supporting their mission, but also the credit unions are improving their return on assets. So we wanted to go through just a real quick, simple example, of options that credit unions have. You could just write a check to the organization, and it's in this case a $25,000 annual expense that the credit union recognizes as a cost. If you were utilizing your capital to fund that, which obviously capital is used in lots of different ways, but you are making an investment decision within your capital, and right now, as I mentioned, that typically earns out 1%. So to earn that $25,000, you would have to invest about $2.5 million. So in the case of a credit union, just doing it as a straight expense and making an annual donation to an organization, you're expensing $25,000, and it's taking up the equivalent of $2.5 million of your capital to fund that. In the case of a charitable donation account, if we utilize a reasonable expected return over the long term for a responsible investment strategy of 5%, it would only take $1 million in capital to earn a $50,000 of income, and then the minimum required donation is $25,000. So utilizing a CDA, you can actually increase your return on assets, fund your charitable donation, and still have excess capital available to invest it as you otherwise normally would. Truly a win-win. This is just kind of another way to show that it really is a win-win and why it's becoming so popular for credit unions all across the country. Our goal at Members Trust Company is to basically offer a turnkey program to the National Council of Firefighters Credit Unions and the credit unions that support them. And we're happy in this partnership and really working with Grant and thinking about ways that credit unions can increase their support responsibly in, obviously what is a difficult investment environment today. A charitable donation account program is a great way to do that. We help the credit union with board policies. You're expected to have a policy for CDA investment, just like any other investment. We have draft policies for you to use. We work with a credit union to develop the initial funding strategy and the underlying investment strategy based on the credit union's goals and risk tolerance, and we'll talk more about that later. We provide all of the third-party due diligence that you'd expect to show to your examiners and regulators, pre-purchase, post-purchase investment analysis, just like any other investment that credit union is making. We do a lot of the administration of the charitable donation account program. We calculate the total returns. We work with the credit unions to then match that to the donations that you've made, and make sure you're meeting that minimum requirement. And probably most importantly is we're managing the underlying investment strategies and portfolios. We're managing risks and working with credit to achieve these long-term benefits that we'll talk about. There are no guarantees in these types of investment strategies and products. So it's important to have a partner that manages risks and can allow you to see the long-term benefits and returns. And that's what we do at Members Trust Company. As we'll talk about, there are long-term benefits and increased returns and return on asset potential. But that comes with the potential for short-term volatility of the income statement. And the type of investment strategy and the size of the investment, all of this matters when it comes to the level of risk that you're taking. We really do everything we can within the investment strategy to minimize that volatility. We understand credit unions. We understand that having a negative income for a month or a quarter is not something that you like to see. And so we do everything we can to minimize that volatility. And there are ways you can do that. The underlying investment strategy, you can be really conservative. Some credit unions are aggressive. That is the biggest way to minimize that volatility. But the underlying investments, the building blocks that we use exchange traded funds that track broad indexes. That helps to reduce that volatility. And just our investment philosophy and strategy also, which we'll talk about. It's really important that credit unions work with organizations that understand them and what their requirements and needs are. And that's what we do at Members Trust Company. We own that credit union. Our investment team is extremely experienced. We are all CFA charter holders. Chartered Financial Analyst designation is one of the more prestigious in the investment community. If you look at investments in general, it's typically CFA charter holders are the ones in managing mutual funds and hedge funds and kind of behind the scenes. We believe in bringing these services and our experience and knowledge to credit unions directly, and so all of our investment staff work with credit unions directly and with members directly, and we think that that's a differentiator and something that is different about the credit union values and ideals is that we want to work directly with the folks that we're managing these investments, and also importantly, CFA designation carries really high ethical standards, as you'd expect with a credit union-owned organization. I say we're conservative investors and we're focused on managing downside risk. We want to get to those long-term returns. Real-world example of that is we were highlighted as a credit union-owned organization, highlighted by Forbes as having the top ETF portfolios in 2008. Obviously, a very difficult market. Being a top performer in that market shows how we're managing risks. But we're also recognized by Morningstar over the last 10 years in a bull market for being either one or two within our categories. So really positive returns. And it goes to show if you manage risks and downside risks, it can really improve long-term results. And also, by the way, we try to minimize costs as much as we can within the portfolio strategy. One reason why our credit union partners came to us to do these services is we want them to keep more of their returns. So our investment strategy is specifically built to keep investment costs really low. Not every credit union is the same when it comes to the level of risks that they're willing to accept. Some credit unions want an investment that's going to provide an incremental return to their capital portfolios. They don't want to take much more risk. Some credit unions are willing to take more risk. What is important is we have lots of different investment strategies to match that with the credit union's risk tolerance. Also, CDA investments are limited to 5% of net worth, which is generally 10% of a credit union's assets. So putting those two things together, these investments are about 0.5% of your total assets. So while they have a long-term positive impact on income and returns, the short-term downside is somewhat limited because they're relatively small investments to the entire organization. So that is one thing to keep in mind as we talk about volatility and portfolio returns. We work with each credit union to develop the investment strategy. That's called the investment policy statement, and that sets the what's called the asset allocation, the mix of stocks to bonds. That's the number one determinant of risk and ultimately returns in a portfolio, and that's what we spend a lot of time on, making sure that the credit union, the mix that they're in, that they're comfortable with and will achieve their long-term objectives. Then generally, we have 10% of flexibility on either side. So in this case, we're looking at a portfolio that's 60% in equities or stocks, 40% in fixed income or bonds. We generally have 10% of flexibility on either side. So if we're really excited about the stock market or think there are opportunities, we could be as high as 70% in equities. If we think that there are risks building up and we want to be more conservative, we can be as low as 50%. And these are kind of day-to-day decisions that we make. Our motto is fewer, smarter decisions. We're not day traders. We're not making investment changes every day. But there certainly are times in the market, as I'll show in a little bit, where you need to manage risk, and then there are opportunities to take advantage of opportunities in the market. We're making the decision. So once we decide on this overall kind of strategy for the credit union, we're making the individual decisions. Well, what makes up the 60% in equities? How much is international investments? How much is in the U.S.? How much is in large companies versus small? Do we have a growth tilt or a value tilt within the portfolio? Those are all the things that we're using our experience in managing within the portfolio. Similar on the fixed income side, do we have more treasuries and really high quality bonds, or do we incorporate more corporate bonds? Now the Federal Reserve is purchasing corporates also, these allocations shift over time as the financial landscape shifts. Like any good investment plan, it needs to have flexibility to change. So it can be changed if the credit union's needs change, or if the markets dictate, or our expectations from the markets think that we should change this investment policy, this overall investment plan, then we're going to work with the credit unions to do that. But there's a lot of flexibility built in to these strategies. One question we get from credit unions, well, the market's been really good the last 6 months. It's been really good since the election. Is now a good time to invest? And what I generally say is it's always a good time to invest. How you start the investment process matters, though. What we're big believers to start the investment process is what's called dollar cost averaging. So rather than moving all into an investment strategy all at once, we tend to spread out the purchases over a period of time. This can be customized for each credit union, but typically what we do is we'll invest about half of the funds initially, could be over the first month, depending on the size of the investment. And then over the next, could be 3 months, could be up to 6 months, we'll invest the rest. That way, if the stock market sells off, we can go in and buy equities when they're on sale, or if interest rates rise, we can go buy more fixed income. It's just a more conservative way to start the investment process, and it offers credit unions peace of mind that is going to limit short-term volatility as you start these types of investments, and as your ALCO group and your executive team and your board gets comfortable with this investment, that it limits the downside potential initially. And we think that that's really important, especially in volatile markets like we're experiencing today. I mentioned the asset allocation. The mix of stocks to bonds in a portfolio is the biggest determinant of risk and returns. And so that's what we tend to focus more of our time on. And I also said that we're conservative investors. And so what that translates to in day-to-day investment activity is, as the stock market is moving higher, we're actually tending to reduce equity risk and taking some profits. That way, when the market ultimately sells off, and markets are volatile, you'll always have ups and downs, we have more flexibility and we've minimized the downside, but then we can also think about being buyers when stocks go on sale. Buy low, sell high sounds really easy. It's difficult to do in practice, but we utilize this mix between stocks and bonds really as the biggest tool to manage risk in portfolios. All other things being equal, we're more willing to give up some return in a positive performing market if that means that we can minimize the downside. And we think that's exactly what credit unions are looking for these types of investments. There are no guarantees, and so we need to manage that risk and volatility as much as we can. You can see if we just use the last 12 months as an example, towards the end of last year, we actually sold equities in the portfolios and went to underweight. The stock market was doing amazing last year. Valuations started to get higher, and we felt like at some point there was going to be some declines and some volatility. We had no idea COVID-19 was going to be a thing. But we did think that the market was going to have a period of volatility. We'd have a chance to buy equities a little bit lower than we sold them. Well, that certainly happened in March. And as the markets were selling off, we felt like there was an opportunity. What we went through in the pandemic and what the financial markets experienced was not exactly like what we've seen in the past, but there were lots of similarities to the financial crisis in 2008, the stock market decline, crash in 1987. And what we did is we looked at those periods and we went back to our playbook from 2008. We said, we are confident that it could be 6 months, it could be a year from now, it could be 2 years from now. But we're confident that we're going to look back and these prices that we're seeing in the stock market are going to be attractive. We would have rather been buyers of equities in these periods than sellers. And so that's what we did. You can see in March, in those big down days when the stock market was down 9% in a day, we were buying equities. And now that the market has recovered and rallied back, we're on the other side of that. And we're starting to take profits again as risks start to build up again in the overall economy and the stock markets. We're pretty optimistic the next couple of years, but we have to get a vaccine. There's lots of things that we have to do in the interim before we can see really positive long-term returns again. But we think the next few years, equity market returns are going to be above average and certainly much better than returns that we'll see on the bond side and within the bond portfolios of credit unions' capital portfolios. So you have to manage risk. You're not going to be in an all-equity portfolio by any means, but having a piece in equities can really be beneficial and really is where you see the win-win for these types of investments. Long-term expectations and returns, you can see why credit unions are gravitating to these types of investments and responsibly incorporating them into their investment portfolios. Even our more conservative portfolio options, we would expect to earn 4% a year. And obviously, as you get more aggressive, returns are generally higher over the long term. Most of our credit union partners are more on the conservative side, either in their income 25% equities or 40% equity portfolio. In fact, their 40% equity portfolio is the most used. But we do have some credit unions that are more aggressive with it. Maybe they have a smaller investment, or they're just more comfortable with the monthly volatility and risks. And they're looking at this holistically in conjunction with their capital and their bond portfolios. And this really is a way to mitigate some of the interest rate risk. So you might be taking new equity risk, but if you look at risk as a whole as a credit union, you're actually reducing it because credit unions just inherently have a lot of interest rate risk. So to highlight again a little bit more that this really is a win-win and why credit unions are looking at CDA investments to not only fund their charitable contributions and maybe increase the support to organizations like the National Council of Firefighter Credit Unions, but also to improve the financial results of the credit unions themselves. I'd mentioned currently the average industry yield on investments for a credit union is around 1%, and that number is actually declining. On this slide, we're showing that on average, looking at call reports over the last 3 years, it was about 2%. Over the last 5 years, it averaged 1.74%. Over the last 10, 1.59. So we know that the environment today is not as good as what the last 3, 5, and 10 years were. But even using these numbers, you can see that an investment strategy like this, while there's volatility from year to year, over the long term, you're seeing returns that are 4 to 5 times more than what you would typically within a capital portfolio. You have to manage the short-term risk to get to those long-term benefits. We spend lots of time doing that, working with our credit union partners. But this is exactly why credit unions are doing charitable donation accounts. You can increase charitable giving and fund and improve return on assets at the same time. I know I keep saying that over and over, but that's really what this comes down to. Is it's just a better use of capital within the credit union's capital budgeting strategy. I think charitable donation accounts and employee benefit funding are two of the best uses and responsible uses of capital for a credit union. The underlying investment strategy matters, and that's why you need to have a partner that you can trust and work with. And that's what we spend a lot of time at Members Trust Company. I know I went through a lot of information really quickly. I'm going to go ahead and open the phone lines here so we can see if anybody has any questions. But in the meantime, while I'm doing that, please feel free to reach out to me at any time about a charitable donation account strategy or just any questions. I truly believe it. At least review it, look at it. Let's look at a plan. Take it back to your ALCO group, your executive team. If it's not right for you, that's fine. It's not going to be right for every credit union. But more and more, we're seeing credit unions interested in executing charitable donation account plans, and I think there are some really significant long-term benefits. So with that, we will go ahead and open the phone lines. And does anybody have any questions? Okay, not uncommon on webinars. Sometimes folks get a little shy about asking questions. That's perfectly okay. We're going to send out the handout, the slides, and even a replay of today's presentation. So you'll be able to kind of go back over it. Please reach out to me with any questions. I'm happy to talk with you about anything we've covered today, and certainly we can go more in depth and more specific to your credit union. But working with Grant, we really truly believe that this is a great way that you can continue to support all the great work that the National Council of Firefighter Credit Unions is doing, supporting firefighters, first responders, and their families. And you can be responsible to your members and actually improve your financial results. So with that, I want to thank everybody for their time, and please have a great evening.